Yeah, Jason, I don't know if you want to respond to Steve before we get to Victoria here to get her take, but the next Fed meeting is a whiles away at this point, right? I mean, it's the end of September.
Really good point.
So there's
data.
Quite a bit that can happen between now and then, but for now, it looks like things are cooling. Maybe the Fed can sort of take its foot off the gas, so to speak.
Yeah, look, this is a much better report than I expected. Seeing a headline number of 0.0 is exciting. There's more reductions in gasoline that we're going to see when we eventually get the August CPI too. I'm much more focused always on the core CPI, that coming in at 0.3. That's the lowest we've seen since September of last year. Some of those inertial components we were talking about, like owner's equivalent rent and rent, those may have been higher than expected, but they did tick down a tenth, both of them. I thought that was good news. And by the way, goods prices were still up. Those could easily be flat or start falling at some point, providing some additional relief. So I never try to take in too much from 1 month's data. For the last 3 months, the core CPI is still running at an annual rate of 6.8%. This could easily be like the false dawn that we saw in September 2021. But for now, I'll take it as a tick in the good direction.
For now, Victoria, could this mean an extension of the run that we've seen broadly in equities since June lows?
It might mean that, Melissa, but I actually am going to be curious to see how the markets play this out for the rest of the day. Obviously, we see this knee-jerk reaction in the futures, but when we look at what really matters for the Fed, as we've been saying this morning, it's that core number. And year over year, that did not come down for core CPI. And the Fed has consistently talked about wanting to see that core number, the month over month and the year over year, come down. So I actually don't think that the Fed's going to look at this and say, okay, great, we can take our foot off the gas. We can slow down a little bit here. I don't think they're ready to make that decision yet. As you mentioned, there is a lot of data left before the next meeting. The next CPI number, I think, is actually going to be even more important because it's going to tell us, are we actually going to start establishing a trend, even though 2 months doesn't really make a trend, but are we going to start establishing that? Or was this just more of a one-off and we're starting to level off and we're going to stay right around where we are? Because it's that sticky component of inflation that follows wages, that follows rents, that is so important here, and I don't see that changing. So I'll be curious to see how this actually plays out over the course of the day.
Victoria, just real quickly from the glass half full standpoint, I agree with everything you just said about the caution ahead. But to the extent that the Fed needs to see several months of at least stable or declining inflation, at least we can maybe start counting now if this continues.
I think you're right, Steve. Like, this could be the start of it. This could be the peak inflation. I'm not sure we get a straight downhill ski moment here, but maybe we start to level off, and that means maybe 50 basis points instead of 75. But I certainly don't see this turning into a Fed pivot at this point. Maybe it just means they don't go quite as fast.
So let's play this out then. If this is peak, but we see it remain sticky and maybe flat, Stephanie, how do you view that? For the consumer, what we know what the Fed has said is that unemployment will tick higher. So consumers will start losing their jobs out there. They're still going to be faced with high inflation, even if inflation has peaked but remains sticky. I mean, how do you sort of process that scenario?
Well, that's why I always look at the year-over-year number from a consumer point of view, because inflation is everywhere. I don't care if it's 5.9, 6.1, 6.5, 5.5. It doesn't matter. It's still high. And if you look at wages are up 5.2%. Everyone talked about rents. That's up, right? And unit labor costs were up 10.8%. And the core PCE is at 4.8%. So inflation is still high. So even if we're at peak, that's good if we go down from here, but we need many more months of the core month-over-month number to come down. But at the same time, the consumer is still feeling pinched. The good news is, you mentioned it, jobs. There's plenty of them as of now. That's going to change. But as of now, if people want to get a job, they can get a job and they can make more money.
According to Information Resources, packaged bread prices are up 15% year on year. Frozen meals are up 23% year on year. Frozen pizza is up 18% year on year. And I just mentioned
the woman at our local Chinese food restaurant who I talked to yesterday said she used to pay $50 for 250 of the white boxes that the rice came in. You know, those little white Chinese food boxes. $69 now.
Wow.
And tuna was $16 for the sushi. Now it was $10 sushi. Now it's $16.
Yeah. So it is everywhere. It is here, Seema. And so I'm wondering if this print changes your view of inflation, of the challenges that consumers face, of the challenges that corporations face. We've seen already it play out in second quarter earnings in terms of modest revenue growth and deteriorating margins.
No, I don't think this changes the picture. I mean, look, it's clearly a good number. In that it wasn't higher than expected. And I think if you were to get a series of these kind of prints, and certainly for the Federal Reserve, it means that they can potentially slow down that pace of hiking. But from a consumer perspective, as you said, this is the breadth of inflation at the moment is very, very significant. So wherever you look, there will be strains on household budgets. And certainly for corporates, given that wage growth is still significantly high, this does mean that corporate margins are going to be under pressure as well. So putting that together, the picture is still one of weakening economic growth. And of course, if the Fed is going to continue raising rates, as we think they're going to go above 4%, this is still a very difficult economic environment ahead of us.